Self-employed, no workplace pension, no problem. The government actually wants to give you free money when you save for retirement. But most self-employed people are missing out on one of the biggest tax breaks available. Let's fix this right now. First up, tax relief. This is the magic ingredient that makes pensions so powerful. When you put money into a personal pension, the government gives you back some of the tax you paid on the income. Here's how it works. Basic rate taxpayers, that's 20%. Every £100 you contribute only costs you £80. Why? Because the government automatically tops it up with £20 in tax relief. Nice.
Nice.
Higher rate taxpayers, that's 40%. It gets even better. You still get that 20% top up, but you can also claim back an extra 20% through your tax return. That means for every £100 in your pension, it only costs you £60. Additional rate taxpayers, that's 45%. The deal sweetens again. You can claim back up to 25% extra, so your £100 contribution could cost you just £55. The tax relief works by increasing the threshold for the lower tax bands, effectively reducing how much of your income is taxed at the higher rates. Unlike employees who get pensions automatically deducted from their wages, self-employed people must actively contribute to a pension from their income. If you're a basic rate taxpayer at 20%, your pension provider automatically claims the 20% tax relief for you. If you're a higher rate taxpayer, that's 40%, your higher rate threshold is extended, meaning more of your income is taxed at 20% instead of 40%, reducing your overall tax bill. Additional rate taxpayers, that's 45%, get an even bigger benefit by shifting income from the 45% band into the lower tax bands. If you run a limited company, you have an extra trick up your sleeve. Your company can pay into your pension as an employer contribution. This is classed as a business expense, so it reduces your corporation tax, a double win. Now let's talk about limits because, of course, there are limits. You can put in up to £60,000 a year or 100% of your earnings, whichever is lower, and still get tax relief. Go over that and you might face a tax charge. And if you're a higher earner, that's over £260,000, your annual allowance starts to taper down to as low as £10,000. Yep, they don't make it easy. Thankfully, that was scrapped in April 2024. No more worrying about breaching a pension cap. Fast forward to retirement. When you take money out of your pension, the tax man wants his share again. So here's the deal. First 25%, tax-free, perfect. The rest, taxed as income. So if you take out big chunks in one go, you could push yourself into a higher tax bracket. So plan smart. Pension tax relief is fantastic, but pensions lock your money away until at least the age of 55, or it's now going to be 57 from 2028. If you want flexibility, ISAs might be better, but they don't come with free money from the government. So if you're self-employed and not paying into a pension, you are literally turning down free cash. Get started, claim that tax relief, and give your future self a big fat pension pot to enjoy. Got questions? Drop them in the comments, and if you found this useful, check out our next video on how to maximize your pension contributions. See you there.